Here I want to discuss with you what's happening with GDP. What are some of the GDP assumptions that we've seen? And here is an adjustment, and this is just came out again. It's constantly going to be a moving target as new data points come out. Things adjust over time. The one thing that I can pretty confidently say is that China growing is near impossible, especially if you've watched our Yangtze River updates with our Three Gorges Dam, looking at just the sheer economic impacts that we've seen. And this is something that we're also going to talk about in the last segment when we look at the Chinese and U.S.-China economic trade war. And when we look at just the fallout overall, India continues to get worse, and the estimates continue to fall backwards. So the fact that India still remains here above the world average is going to be difficult. So we expect some of these to get much worse as the year progresses, with some of them starting to get a little bit better. So when we look at some of the emerging market components, so the ones that we're going to kind of call out as China, South Korea, and India at this point, South Korea will remain, I think this is a good estimate, of something probably closer to 3%, depending on how the trade moves are going to continue, and that's something that we're going to talk about at next week when the August data comes out for their trade. But when we look at India continues to get worse, and that's something that we're going to talk about later on, which is going to be a huge weight when we look at their overall GDP, which we think is going to come in much closer to, let's call it, down 10% versus where they currently sit. The other side is going to be what is going to happen overall when we look at France, Italy, Spain, because some of the estimates remain very weak, and we want to kind of dig in a little bit more of what is driving some of that negativity, because some of it is going to be sticky in terms of just some of the impacts to tourism and other, but it's just there were already problems, and the problems that already persisted specifically in Europe is why some of these numbers are going to be so weak, just because we're starting from such a weak footing. The U.S. is going to fluctuate back and forth. It's going to really kind of come down to what does Q3 look like. Like the Atlanta estimate is about 25% increase for this quarter. The New York Fed is anywhere between 15 and 17%, depending on some of the data points. But again, we're still waiting for more. And the open-ended question is, what's going to happen this winter? But let's work with what we have and the expectations that we can work with. And this just looks at what is going to be the impact to tourism, because tourism, I think we can all agree, is not going to normalize just based on spending, COVID, all other types of nonsense is going to keep people from moving around. And who is that going to impact the most? And it's very clearly going to be Italy, Spain, Mexico. But Italy and Spain is a bigger piece when we consider Europe, as we can go back to the GDP chart and the impacts that we're going to see. France is also going to be impacted, but not to the same extent as Italy and Spain. And I was actually having this debate with my wife. Is it because more people want to go to Italy versus France, or maybe there's more manufacturing, there's more other things in France to help offset the amount of impact tourism has on underlying GDP. All of those things are probably alike. As being 100% Italian, I'll default to more people wanting to go to Italy, sure. So then we can see China. China is going to continue to have a tourism issue. They've already locked down. And again, these countries have also limited the amount of tourism they are going to allow in. So this is going to impact GDP overall versus 2019. And 2019 was already struggling a little bit as consumer spending and some of these other little bellwethers were starting to crack. So we were already coming into this weak footing. So GDP headwinds will persist, specifically on some of this tourism side. But now let's look at global trade, because we've seen a nice resurgence of global trade as we look at the June numbers and as we go into July and August. So when we look at it, June jumped about 7.6%. When we consider the month over month, we're still down about 12.5% for the quarter. July will see another increase. It's August that's going to see the decline. And that's why we're looking at this going forward, because we're starting to see that turn. But again, what is August going to look like? And we've started to see those declines start to increase when we look at not only just China, but also South Korea and India, which was what we're using for some of those data points. And if you remember last week, we talked about the German toll miles have actually gone down. They peaked in July, and then they actually fell back in August, closer to June, on their way lower. So that's why we're confident in saying, just based on the ship tracking that we're doing, the things that we're watching, that we are going to have an increase in July. It's going to look a little bit better, which is, again, that positive that we want to see. But as we see COVID cases start to increase, even though things look better, governments are saying we're not going to lock down, it doesn't mean people aren't looking at that and saying, well, do I have to go to the store? Do I have to do something? Or can I wait a week? Or can I wait? Is that store really that important? I can just get everything here. And that's why you're going to start to see some of these adjustments. Again, we're still coming off of a huge bottom, and we're going to find this normalization. It's going to be below on a negative level year over year, but at least it won't be at the rates that we've seen. But again, global trade was something we've been talking about as a huge concern starting July of last year. So this isn't something we expected. And if you look at this chart, you can see as we came into the end of 2019, those declines were increasing. You saw the acceleration. Look at the white line. The white line is looking at the 3-month over 3-month change. You can see before we got into 2020, we were already on this path. We were already declining. Japan, South Korea, Germany, US, they were all showing those signs. And given we had trade wars, I'm not saying we didn't, but there was more beneath that, because you can see where the trade wars came in and those declines in global trade. It's the trend that it started in 2019, that middle of 2019, and then it just accelerated in 2020, given obviously COVID. Now, when we look at just deficit spending, it's important to appreciate that we've been deficit spending essentially since 2019. And this is looking at things overall. And when we talk about 128 months of growth and all these other components here, you can see kind of where we sit for 2020 and just the increase in deficit spending. And the reason why this is important is because in the last segment, we're going to start talking about real yields. We're going to start talking about, what does this mean when we're looking at borrowing from a sovereign level, not just a corporate level. And next week, we're going to do a much bigger segment looking at the different foundations of inflation and where do we think inflation and deflation kind of sit. Because for every inflationary pressure you can also find a deflationary pressure. And the question is going to be which one offsets, or do they all kind of shift in the same direction, or does that just keep us in stagflation? And we kind of see that going forward. Again, that'll be its own segment next week. So when we look at the deficit spending, when we look at the things that have been going through, again, this is going to the consumer, this is going to the businesses to try to incentivize economic growth. We have to understand the inherent mobility index and some of these high frequency components. So when we look at the overall change, again, we've shown this chart a million times. We'll continue to show it because I think it's a treasure trove of real data. You can see China really starting to roll over, and we think China is going to continue to slow, even though they haven't seen some of these reinfections. If you want to believe them, they have a real problem along the Yangtze River, specifically in terms of manufacturing, livestock, crops, just inherent flooding that is going to be a bigger problem as we go forward, which is something we'll talk about in a little bit. And here you can see some of these emerging markets, starting to roll over a little bit. But again, it's this 7 day, this average kind of everything's holding still. But the bigger thing is when we break it out and look at specific countries, because as some countries are getting better, others are getting worse, which is kind of holding us within this level. But it's going to be the magnitude of who is getting worse that we are concerned about. So here, when we look at the emerging markets, the two that we really want to look at the most is going to be China and India. Now, India has continued to struggle to kind of get off the floor when you look at the COVID ramps, the issues on industrial production. India has been struggling, and they're actually starting to roll over a little bit, which is going to weigh on some of these metrics, as well as China. As you can see, China is starting to roll over as well. So when you look at this chart, you have to appreciate that India and China will have a different impact overall in the global economy than, say, a Colombia getting worse or a Chile getting better. Those are things that we have to consider when we're looking at just the sheer magnitude of production, consumption, export, imports. What does this mean for the global economy? And the other thing that's going to be interesting is Turkey, because Turkey remains a problem. Even though this looks like the daily indicators are getting a little bit better, there is a huge amount of headwinds when we start talking about Turkey, Greece, the Mediterranean, which we did a whole special update where even though it's 2 weeks old, it's still highly relevant because we covered a lot of these topics, especially looking forward. And Turkey's going to be a problem, which we'll look at when we discuss the US dollar and real yields. And the other, again, kind of coming full circle and looking at these daily activity indicators. So this is an important one because these are looking at the major economies, what's happening in the world. And we're seeing some of the European countries roll over. Now, if you remember in segment 1, we talked about COVID, no lockdowns, increases in COVID cases, but nothing to get too concerned about. It doesn't mean people aren't going to change their spending patterns and the way they consume. So even though, yes, the change in South Korean infections has increased in terms of the infection rate across a small number, it doesn't mean that people aren't going to respond. And that's what we're seeing here. South Korea is responding aggressively. And you've seen a huge drop off essentially through the month of August, going from about 80 to 60, and it's starting to kind of normalize at the 60 level, which has been kind of that sticking point and that support level when you start to consider the whole country, and some places will act differently. These are pieces that are going to weigh on just the general economy overall. Like the US continues to kind of suck along at these levels with not too much going up or down. And you're starting to see Italy and France start to roll over a little bit. Again, coming back to, even though these numbers aren't overly scary when you consider about the holistic view of it, it doesn't mean people aren't going to adjust. And that's what we're seeing, an adjustment. And, once things come back to normal, we'll start to see this normalize. But again, these are going to impact gasoline demand, economic consumption. These are the things that are really going to impact the way GDP is going to look. And these are headwinds that are going to be faced not only in 2020, but also 2021 when we keep hearing about this V-shaped recovery.